Welcome to section 9, and in this section we are going to study the bond markets and the fixed income markets. You'd have heard me say before that this is one of the most important markets to follow. And granted, you may or may not ever trade a bond. You could have some fixed income instruments in your portfolio. However, trading bonds is generally not something the average investor does. What they do is they will have a financial advisor who will allocate some money, some of your portfolio money, to bonds. And that's how it generally works. But you may be surprised to know that the bond markets trade on a 24-hour basis, and the futures trades on a 24-hour basis. And the bond markets are very, very active. And it's one of the most important markets to follow. And we'll see why. The bond markets are connected with the stock markets, they're connected to interest rates, they're connected to inflation, money printing, central bank intervention. There is all kinds of implications coming from the bond markets. And so that's why I call it one of the most important markets to follow. But it's not a simple market to understand. So let's see if we can break this down in simple terms. And I'm going to stay away from any complexity, but just simply explain to you how the bond markets works. And there is obviously a lot more detail to it, but I don't want to confuse you. I want you to get a good basic understanding of how the bond markets work and what are the implications for us, because that's really the more important takeaway. Okay, so let's look at the bond market overview. The US bond markets are the largest in the world, over 60 trillion, perhaps even closing in on 70 trillion. And that's because the US issues a lot of bonds, and worldwide investors buy these bonds for safety, for protection of principal, and so on and so forth. Now, Europe has started also issuing. The ECB, which is the central bank there, has started issuing bonds. It's about 20-25 trillion. Japan is another 20-25 trillion. And the rest of the world is actually fairly underdeveloped in terms of the bond market. They are probably about 10 trillion. The primary function of the bond market is to fund US government expenditure. So the US government issues bonds, and investors pay. Let's say most bonds have a face value of $1,000. So investors pay $1,000 and they get a bond. The bond carries with it some interest. Let's say it's 4%. And so the government says, okay, here's a 30-year bond, and I'll take $1,000 from you and I'll give you 4% per year for the next 30 years. People invest because then they are fairly confident, obviously, that the US government will back up its promise, and they will ultimately provide income as well as the guarantee of principal after 30 years. Now, there's not just 30-year bonds. There are 10-year bonds, 5-year bonds, 2 years, 1 year, and even for 3 months or so. So there's all these short-term and long-term bonds available. The US government bonds are in general regarded as the safest investment in the world. Basically, even though, if you recall, the US credit got downgraded in 2011 from a AAA down to a AA, I believe, but that hadn't been done in 100 years. So this was after 100 years, the Standard & Poor's downgraded the credit of the US government. The debt was becoming a large number. And in fact, even today, the debt is still increasing. As of 2016, the debt is about $19 trillion. In any case, it is still regarded as the safest investment in the world, and it acts as a benchmark for all other financial assets. So even the UK government bond or the German government bond, all these other assets, corporate bonds, junk bonds, muni bonds, everything uses the US government bond as the benchmark. So if the US government pays 4% for the bond, no other asset class in the world will offer less than that. Because to offer less than 4%, they would be deemed to be less riskier than the US government. As we mentioned in the intro section, there are corporate bonds, there are muni bonds. Muni is the local government, state government, local governments. And there are something called junk bonds. It's a bad word, actually. It's just a high yield bond. These are companies that are willing to pay a lot more interest. So there's all kinds of bonds available in the US. Bonds and stocks, they compete for capital. And this is what is called the risk on and risk-off modes. Now, equities, which is stocks basically, are considered a riskier asset, and for good reason. And equities have a lot of volatility, and you can lose money, or you can lose a lot of money on that. So, whenever the environment is bullish or the sentiment is bullish, you would call that a risk on mode. And during those times, what happens is capital goes into the stock market. And then when there's a crisis or when there is a negative sentiment in the market, at that time, people will sell stocks and move into bonds and other safe haven assets. So there could be many other safe haven assets. Sometimes gold acts as a safe haven. The Japanese yen acts as a safe haven. The Swiss franc also acts as a safe haven. It's either a good sentiment or a bad sentiment, and that's what decides where money goes on a daily basis. And so we're talking about lots of money going in and going out from the bond markets to the stock markets, or from the stock markets to the bond markets on a daily basis. And this is all smart money, because bond markets in general are run by smart money. As I said, it's very rare that retail investors would even get into this market. They're generally considered to give you the right kind of indicators on the economy or the sentiment. And so it's important to watch what the bond markets are doing. So what I want to do now is to go over to the platform, and I'll show you how we can study bonds on a platform itself. Okay, so on the Thinkorswim platform, you have bonds that are represented. Now we're going to look at the 30-year futures. Okay, so that is /ZB, ZB. So this is the 30-year bond. You can see it's up about 1.24 today. That's because the stock markets are down. So right there you can see money is coming out of the stock market and going into the bonds. Let's go take a look at the bond charts for 1 day, 10 minutes. You can see the bonds are going higher. I want to do a 20-year monthly. It goes back only till 03. You may have read that in the 1980s, interest rates in the US was almost 16 to 18%. And that's when, at the time, the Fed chairman, Paul Volcker, came and he wanted to crush inflation. Inflation was very heavy. And so the interest rates were about 16 to 18%. So if you bought a bond during that time, you could be getting about 16% fixed income. And that's a great return for fixed income. When interest rates are high, bond prices fall. And so we'll study that whole relationship in the next lecture. But basically, whenever bond prices are high, then interest rates are low. And whenever bond prices are low, then interest rates are high. So in the 1980s, you could imagine you would have got a bond that would pay you 16% per annum for 30 years. That was the peak of the interest rate regime. And since the early 80s, interest rates have been steadily falling. Now, granted, at some points especially during the bubble times, there'll be small increases in interest rates. But overall, from the 16 and 18% in the 80s, interest rates generally have been coming down. So if you had bought a 30-year bond at that time in the mid 80s, say, then that bond would be maturing right now in 2016. You would have collected a 16% per annum income on those bonds, plus the value of the bonds itself is worth 170. So you could have sold that bond for 170. So not only did you get a fantastic interest rate on your bond, the price of your bond also went up. Now, why does that happen? Why do bonds prices change? And so this is all a very interesting set of relationships here, which we'll study in the next lecture. But for now, I just want to show you that the bond market is a very active market. And here you can see in the 2007-2008 crisis, here the crisis started somewhere around October 2007. And boom, you can see as the stock markets were crashing from the middle of 2007, you can see that the bond market started to go up, and boom, it reached, in fact, let's see, what was the low here? About, let's say, 105. And it reached a high of about 142. That's like almost a 40% increase in 1.5 years in the bond market. I mean, that's pretty phenomenal. So for bonds, because these are fixed income instruments, their main source of income is, as an investor, you're expecting your interest income. So while you're getting the income, you're also getting a bump up in the prices of the bonds. So that's like a double bonus there. And of course, when the stock market started recovering, then some of that came down. But you can see that the bond market has been, in general, this is an upward graph. Even from 2009, this is an upward graph. Granted, there are big ups and downs, but it's going from a lower left to an upper right. So that is an upward graph. So the stock markets have been going up and the bond markets have been going up. So why is that? So that's the big conundrum that we face today, is that the stock markets are going up, the bond markets are going up. Generally, these should be going in opposite directions. So why is it that both these markets have been going up for the last few years? So because if you see the SPX, which is the S&P, over the same time period, it's been going up from 09. It's a steady climb. Why are the bonds also going up? So this is really the question that most people have to think about. And when we say that the bond market is all smart money, there's also another saying that says the bond market is always right. So when you look at the stock market and the bond market and you see some conflicting information coming from these two markets, they say always trust the bond market. So which means if you trust the bond markets, what the bond markets are saying, we are at an all-time high in the bonds, we are close to an all-time high in the stock market. Something has to give right now. If you go with the bond market, that means the bond market is right. Then the stock markets will see a crash. And so if you see the SPX chart, you will see that the high was 2134 in the middle of 2015. And since then, so we've corrected about 20% already. Now, how much further this can go, we don't know. But just looking at both the bond markets and the stock markets, it's telling you that both of these cannot go up at the same time in the same magnitude. And therefore, one of them is right, one of them is wrong. Now, the other issue is, over the last 6 years, there's been market manipulation by central banks. So the Federal Reserve has played a much, much larger role in the markets during these years. So we'll look at the impact of what the Federal Reserve also has done. Now that also could contribute to this conflicting look that we see, because markets are being, well, maybe manipulated is too strong a term, but certainly there is intervention. So, you're intervening in the normal operation of the market by coming and providing this cheap liquidity and money printing and all of that. So this is just a brief overview of the bond markets and where it stands in the financial landscape and what its relationship is to stock markets. So in general, you would see an inverse relationship. If the bonds go up, stocks come down. If stocks go up, bonds come down. Anyway, so let's go over to the next lecture and let me show you some of the more intricate elements of the bond market.